Welcome everyone to Dollars with Sense with your two financial gurus as we discuss the topics around financial planning that can have a direct impact on your knowledge and how to grow your wealth. My name is Ela Lange and I'm here with my co-host Terence Vanderwood.
Thank you, Ella. I'm happy to be back for another week of financial advice to all our listeners. But not only that, with each of our episodes, we also have a practical hands-on action item at the end that you can take away and complete to take your next step towards financial freedom.
So today's topic is this: why mutual funds make more sense. We're going to show you the difference between a good investor and a bad investor, and how mutual funds can protect you from the highs and lows of the market, commonly referred to as market volatility.
While there is no legal definition of the term mutual fund, it is most commonly applied to open-end investment companies, which are a collective investment vehicle that is regulated and sold to the general public on a daily basis. They are sometimes referred to as investment companies or registered investment companies. Hedge funds, though, are not mutual funds, primarily because they cannot be sold to the general public. Once a small player in financial markets due to their meteoric growth in the late 1980s and early 1990s, mutual funds now play a large and decisive role in the valuation of tradable assets such as stocks and bonds.
The first mutual fund or mutual funds were established in Europe. One researcher credits a Dutch merchant with creating the first mutual fund in 1774.
You ain't Dutch, you ain't much.
Mutual funds were introduced to the United States in the 1890s, and they became popular in the 1920s. In 1929, mutual funds accounted for only 5% of the industry's $27 billion in total assets. The Securities Act of 1933 required that all investments sold to the public, including mutual funds, be registered and that they provide prospective investors with a prospectus. That's a piece of paper that discloses essential facts about the investment.
When confidence in the stock market returned after the Great Depression, by around the 1950s, the mutual fund industry began to grow again. By 1970, there were approximately 360 funds with $48 billion in assets. Fund industry growth continued into the 1980s and 1990s, which was the result of three factors. 1, a bull market for both stocks and bonds. 2, new product introductions, including tax-exempt bonds and international funds. And 3, the wider distribution of fund shares. Among the new distribution channels were retirement plans. Mutual funds are now the preferred investment option in certain types of fast-growing retirement plans.
At the end of 2015, there were over 15,000 mutual funds in the United States, with combined assets of $18.1 trillion, according to the Investment Company Institute. The ICI reports that worldwide mutual fund assets were $33.4 billion trillion on the same date.
So here's a list of advantages and disadvantages of mutual funds. The advantages is increased diversification. A fund normally holds many securities, and diversification decreases risk. We will get more into that later on. Daily liquidity. Shareholders of open-ended funds may sell their holdings back to the fund at the close of every trading day at the price equal to the closing net asset value of the fund's holdings. Lots of words in there, but we're going to get into more detail around daily liquidity later on as well. Another advantage is professionally invested management. Opened and closed-end funds hire portfolio managers to supervise the fund's investments.
Ability to participate. That's another pro in the investments that may be available only to larger investors. For example, individual investors often find it difficult to invest directly in foreign markets. Mutual funds help you get over that. Government oversight. Mutual funds are regulated by the MFDA. and the ease of comparison. All mutual funds are required to report the same information to investors, which makes them easy to compare.
The disadvantages to mutual funds, one of them is fees. We'll get more into that later on. Less control over timing of recognition of gains. In other words, the securities that are in your portfolio cannot be traded on the same day. Inside of a mutual fund, you have to wait until the close of day to be able to trade from one fund to another. And final disadvantage, no opportunity to customize. Most mutual funds are pre-bundled with securities chosen by the fund manager and regulated by the fund mandate. So let's explore a little bit around diversification. Let's say you have, Ella, let's do a little bit of role playing here, and let's say you're the investor and you have $10,000 to invest.
Awesome.
What's your favorite restaurant?
Well, I love Moa Box, just downstairs from our offices. Casa Napoli in Port Moody. Earl's, just around the corner from us. Urban Gate. The Boathouse. Ooh, I like them. And Port Moody.
Excellent. That's a good list to start from. So let's say you have $10,000, and let's just assume all those restaurants that you just mentioned are publicly traded. So there's two ways that you can do this. When one generally thinks about investing their money, they go, I have $10,000. I really like Moa Box. I'm going to put it all into there. Right. That is not diversified, but that is often what people do. In the other case, and if you look up on your screen now, it will show you, it'll give you a visual representation of what we're talking about right now. So if you have $10,000, and I suggest let's diversify it and let's put it into the 5 different restaurants that you just listed off. So you've got $2,000 in Moa Box, $2,000 into Casa Napoli, correct? $2,000 into Earl's, Urban Gate, and the Boathouse. And now let's say that at Moa Box, a nasty piece of fish makes it through into some food. And that food is consumed by their customers, and they get food poisoning, and a couple of them die.
Wow, tragedy.
Which is a big tragedy. And then the families turn around and they sue Moa Box, and Moa Box goes, well, we have to go claim bankruptcy because we can't afford it. Mm-hmm. So the $10,000 that you've invested into Moa Box, it goes away. Gone completely. Now, if you took good advice and you diversified yourself, then you would have lost $2,000 into the Moa Box. But the upside of that is that, do you think the people that were eating at Moa Box, do you think they would stop going out for dinner?
Oh, they're going to go somewhere else, right?
Definitely. They may possibly go to Casa Napoli and Earl's and Urban Gate and Boathouse. And therefore, you will actually make your shares will make more money because of that loss. So on one hand, if you have $10,000 fully into security, you're going to lose it all. But on the other hand, if you have it into a mutual fund of $10,000 into the mutual fund of restaurants, then you're going to be okay. You're going to have some money.
The profits of my 4 other restaurants will offset the loss of Moa Box going under.
Correct. Really well put. And then on top of that, in most mutual funds, that is just one asset that gets put into place. So restaurants could be considered consumables, and then there's also energy, and then there's also finances, and there's resources, and et cetera, et cetera. So every mutual fund, according to its mandate, is made up of a bunch of different securities, and therefore is able to offer you diversification, which is the key to growing your wealth.
Fantastic. Thank you for that, Terence.
Thank you.
In the end, daily liquidity is a very important part of exponential growth. Essentially, they are 2 ways that a stock or share from a company earns you money. One is its market value, which is determined mostly by the actions of the investors, of which there are billions worldwide. Market volatility comes from shareholders who decide it's time to either buy or sell their given investment. It's impossible to predict and very difficult to manipulate because of the sheer volume of investors that are behind those investments.
An interesting example of how the sheer volume can hinder manipulation is an example from China about 18 months ago. There was a big dip in the market because its market was in trouble. Because it is a communist state and the structure they have in place controls quite a large portion of their market, it appears that they tried 18 months ago to influence the market to make their dollar stronger and to keep the pace of growth going as it did in the 2000s. In my opinion, it failed as China went through their version of the 2008 financial crisis because of a result of trying to manipulate their market. What I'm trying to say is that the market itself is an organic, flexible entity and is very difficult to manipulate because of the sheer volume of the number of investors that are behind the markets.
The other way a stock makes you money is by the yield. So when a company pays its shareholders a portion of the profit that it has earned, it's known as a yield. The importance of daily liquidity inside a mutual fund fuels compounded growth because the yield that is paid out can automatically purchase more shares of that company. When owning the stock individually, this process is not automatic and usually triggers a trading fee to rebuy into the same stock. With a mutual fund, it all happens while you're busy living and enjoying your life.
Of the disadvantages that we listed earlier, the one that we hear about, and you hear about the most, is the fees. With every mutual fund from every institution, like banks and credit unions and any other institutions that have mutual funds, there is what is called a management expense ratio. This is a percentage of the returns that the institution uses to pay for the folks who administrate the funds, who manage the funds, who distribute the funds, and in the case of Investors Group, the individual who is responsible for monitoring your choices and financial health. You guessed it, that's your financial planner.
So the management expense ratio, or MERs, can vary widely from institution to institution. In today's media-soaked world, the area of growth loss is what is focused on due to the MERs. For example, if you have a fund that's giving you a rate of return of 7% and your MER is 2%, then the real rate of return from that investment is 9%.
In order to put the cost of MERs into dollar figures, let's say you have $10,000 and you earn 7% annually. So after 20 years, you will have seen your money grow from $10,000 initially to $40,000. If you would have the same scenario at 9% rate of return, your money would be worth approximately $56,000 after 20 years. That's $16,000 is a big difference. And in turn, this difference is all that the focus turns to within the media. And why not? Everybody dislikes fees, and $16,000 over 20 years equals to $67 per month. That's not chump change.
No, of course not. And what is not focused on is the potential loss that can and does happen when the focus becomes around what I'm paying in fees. A typical situation is that the focus on fees gives one the idea that to manage they can manage their own assets on their own, so to save those fees. The downfall of the average investor is that because you are human, and two emotions that will cost you way more than any amount of fees are fear and greed. Again, the reason why the MERs exist is so that the experts and professionals can administer, allocate, distribute, and advise to protect from those two powerful emotions.
We have all heard the saying, buy low and sell high. Its simplicity is deceiving and is usually not achieved by the individual investor. Take, for example, the extreme of 2008, the Great Panic, it's been coined as. At the time, if you had $100,000 in a moderate, aggressive mutual fund, at the lowest point during that time period, during the Great Panic, your market value of the mutual fund could be as low as $60,000. Most people would say in their minds, I have lost $40,000. This fund is losing me so much money I can't afford to hang on to it anymore. It seems the best idea is to cut my losses and save the rest so that I have something for my future.
Let's continue on this story and say that the person that sells all the assets puts it into a savings account, thinking at least it won't go down, and I'll reserve it for the next good investment I find. As the weeks and months go by to decide what to do with it, the media is focusing on the launch of Facebook. Tesla is also seeming like a good investment, and there are a couple of others that the Weekend Globe is recommending as the winning stocks. That $60,000 investment goes into 4 different stocks equally. Facebook plummets after its initial opening. Tesla has troubles with cars catching on fire and dips 25%, but the others are gaining 2% and 5% for that year. That leaves you with the starting point of your retirement nest egg with approximately $60,000. But worse than that, you have done the exact opposite of the way the market makes you money. You have sold low and bought high.
In comparison, let's look at someone who uses a professional advisor and trusts them to make the investment decisions. Same amount of money, $100,000, that is now worth $60,000. The first thing is that there is no loss. Only if they cashed out would there be a loss. So this investor doesn't give in to the fear and keeps the money in the mutual fund. Then the advisor tells him, you probably don't want to hear this at this time, but do you have more money to invest? Because right now the fund is at a 40% discount.
On sale.
The investor agrees and is able to put in another $10,000 into the mutual fund. The next year, as what happened in 2009 and 2010, that same fund recovered from the down market of 40% and increased its return by 25%. That means this investor has earned an additional $2,500 from the additional investment of $10,000, and the market value of the $100,000, the original amount, has increased to $125,000, giving him total assets of $135,000. This brings our wise investor to have $75,000 net worth more than the do-it-yourself investor. Is that worth $67 a month?
Have a look at your screen to see what we mean by the market volatility. This super graph in front of you shows the market performance of $1,000 invested in 1935 to today. Each line represents a different risk level of securities, and they all vary in what their growth pattern and rates are, or what they were. What they do all have in common is that there's a continuous climb in an upward direction. So regardless of the big events that affected the market, like 9/11 or the Iraqi war, or you'll also see the dot-com collapse, and etc., wherever you are invested, if you conquer your fear of losing it all, your money grew. In the example of a moderate portfolio returning 8.9% annually, that $1,000 investment in 1935 is now worth $1,005,000, $1,005,440. You'll see it there.
So your action item for today is to take a close look at all your asset portfolio and make sure that you are diversified to take advantage of the markets around the world and here at home. What I also mean by diversification is looking at real estate as an asset too. If all your eggs are in that basket, in other words, local real estate, you think you'll be safe because look at what has happened to the market real estate recently, right? Well, what do you think will happen if the lower mainland experiences the big earthquake that is statistically long overdue? Do you think the markets will continue to trade in New York, London, and China? Absolutely it will. And do you think that scenario will affect the real estate value in a city that the world will now avoid because it is too dangerous? Absolutely it will too.
So again, the action item is to talk to your financial planner about your portfolio. If you don't have that kind of relationship with your advisor, or you don't have an advisor, it's time you got yourself a great financial planner. Let us, your two financial gurus, help you with that by contacting us by phone. Give us a call on 778-879-0820. You can certainly email us at twofinancialgurus@gmail.com. It's the number 2financialgurus@gmail.com. You can check us out on our Facebook page entitled Dollars with Sense, or certainly go to the YouTube channel that we've set up under Ela and Terence in the search bar, and you'll see us there.
Thanks so much for joining us today. We hope this episode has been useful for you and your financial outlook. If you have been enlightened, do not keep it a secret to yourself. Each and every one of us, regardless of income and size of assets, will only benefit from a financial planner. So please spread the good word by sharing this episode with your circle of friends and family. These episodes are always available on YouTube, as Ella said, and we welcome and will answer directly your questions around smart financial planning. We hope you have a wonderful week. And from Ella and Terence,
may your dollars and cents be with you.